I am Kim Snyder, and thank you so much for joining me for the Sane Crypto Podcast, the first cryptocurrency podcast for baby boomers investing for retirement. This podcast is brought to you by the Sane Crypto Mastermind, which is my signature program for those who want the diversification benefits and return potential of cryptocurrency with the guiding hand of a 20-plus year investment professional who also has a proven track record through both bull markets and bear, namely me. Now, because it feels like people are getting just a little bit panicky between the losses in the stock market and their cryptocurrency portfolios, I've created a brand new free guide that I've called When Things Get Wild, How to Protect Your Portfolio and Still Get a Livable Return. You can find that at kimsnyder.com/bear market. Note that is all one word, and it is on kimsnyder.com, spelled SNIDER, not the Sane crypto website. So again, to get my free guide, When Things Get Wild, How to Protect Your Portfolio and Still Get a Livable Return, you go to kimsnyder.com/bear market, spelled KIMSNIDER.com. Hit the orange download now button on the right-hand side. All right. Most people still cling to the quaint idea that Wall Street's job is to make you money. In fact, nothing could be further from the truth. Most investments and most investment advice is designed to make the person selling it rich, not you. And I was reminded of this by two different questions that I received from mastermind members within the last couple of weeks. One, more recent, was asking my opinion on some of the aforementioned advice that, to those who understand basic finance and investing, can only be a blatant, bald-faced ploy to take money for bad advice from people who don't know better. And the other question was asking, what does someone look for, or how do you choose a trustworthy, competent financial advisor? And sadly, that's easier said than done. So the thing that has always stuck in my craw is the fact that the financial services industry is chock-a-block with perverse incentives. It was set up that way. At least they are perverse from the perspective of the investor. And look, if you show me the incentives, then I can predict the outcome about 99% of the time. And this is deeply personal for me. It has been since I was an innocent, doe-eyed victim of those perverse incentives myself, close to 25 years ago. If you haven't heard the story, and by the way, I covered it in detail not too long ago in episode 43, What's the Biggest Mistake You Have Ever Made as an Investor? The short version is that after college, just by dumb luck, I went to work for a company in Dallas as a part-time clerk in their purchasing department while I was waiting for school to start. I just moved to Dallas thinking that I was going to get my MBA. And at the time, this company that I started at, they were doing about $36 million a year in sales. And thanks to a series of pretty improbable events, like the two full-time people in the purchasing department running away in the middle of the night to get married on my third day and never coming back, I ended up staying with the company for, I think it was somewhere around 8 years. And over that time, they went from $36 million a year in sales to over $1 billion a year in sales. And I went from being a part-time clerk to senior management with the company. The last project that I worked on before I left, along with lots and lots of other people, by the way, was taking the company public. Now, because a company growing that fast is perpetually short of cash, because again, this was like way before the internet bubble and competitive VC markets like we have today, much of our salaries were being paid in stock options. So on the day we went public, I was theoretically, if I played my cards right, set for life. And I hadn't turned 30 years old yet. But as you can guess, I didn't play my cards right. Far from it. Even though I'd been to some of the finest schools that this country has to offer, I knew a lot about corporate finance and running a business, but I knew absolutely nothing about personal finance and investing. So I did the thing that social proof told me I should do, which was to turn all that money over to the experts, over to a broker at a big name, well-known Wall Street brokerage firm who said that they would take care of everything, that I didn't need to worry my pretty little head about a thing. And this wasn't just some broker I had pulled out of a phone book. This was the person handpicked, recommended to me by the investment banker that I had worked with on the public offering in their firm. Again, a company who, unless you've lived your entire life under a rock, or maybe you are under the age of 30, you will know the name of this firm, okay? And 2 years later, every penny that I had not managed to spend, which admittedly was a lot of money on a lot of really foolish things, they had managed to lose. In a bull market, no less, which is no easy feat. Unless you are operating under perverse incentives, which they were. I mean, silly me. Like me, like you, I naively assumed that the advice that they were giving me was designed to make me money, that they had my best interest at heart, that I was their client. And I was. But their investment banking arm made lots and lots and lots, billions of dollars, taking companies like ours public. And what most people don't know is that these firms take on risk themselves in many different ways in these public offerings. This was the lead up to the dot-com bubble. So some of these were companies that they could make a book for, and some weren't. So their biggest incentive was to get these companies public and then get the risk off their books, and if that's what it took, onto the books of their clients. Their retail clients, particularly accredited investors, which I was a newly minted accredited investor, were perfect dumping grounds for all the crap companies that they couldn't make a book for. Note to self. If you aren't the top of the food chain and someone tells you that they are doing you this great favor, getting you into some investment, automatic red flag. If it is really that good of an investment, you wouldn't be getting it, I promise. So 2 years later, I'd lost everything. But boy, did I learn a lot. I got street smart in a hurry. And then I decided to just jump right into the shark's den because I was going to figure this thing out, which is how I eventually became an off-floor options trader on the Chicago Board Options Exchange, went on to invent an investment method for my own use, and then later founded an Inc. 500 investment advisor firm, teaching people for whom it was appropriate my method of investing. What I learned being on the inside, and then it became obvious even from the outside looking in, is that, again, the incentives are completely aligned against the retail investor. The worse an investment is, the more they pay people to sell it. Right? That's just kind of the bottom line. And it only makes sense because without that additional incentive, all things being equal, the advisor would sell the better investment for the client. Okay? Now, so the worse an investment is, the more they pay people to sell it. Well, the more people who sell it, the more people who buy it. Not because they want it, but because they have been sold it. And the basically random odds of short-term investing means that in any pool of investors or investments, some of them will be successful. And of course, those are all the successes in the ads and the testimonials, in Twitter feeds. No one publishes the investors who lost money or the funds that went out of business because they were so bad. Social proof says, in the absence of certainty, a human being will look around, see what everyone else is doing, and do the same thing. And when we look around, what do we see? Mostly, we see random odds and a skewed representation of results on a bunch of investments that were bad and sold, not because they were right, but because they paid the advisor the most. And it just becomes this vicious, self-perpetuating circle. And sadly, by definition, the opposite is also true. The more an advisor does that is in the client's best interest, the less money they make. That is a fact. And that's what I mean by perverse incentives. The Economic Policy Institute estimates that investors acting on bad advice from advisors cost them $1.9 billion a month, or roughly $23 billion a year. And this doesn't even include the impact of advice given elsewhere, including financial gurus, newsletter writers, courses, and even the mainstream financial press. You know, as just a quick heuristic, in my experience, the bigger their house and fancier their cars, the less likely an advisor is to be acting solely in your interest. I mean, in a perfect world, right, you'd want an advisor whose wealth comes predominantly from successfully managing their own money, as opposed to commissions on managing yours. But since we can't always find that or see it, here are 7, I'll just call them like glaring red flags that tell you don't walk away from the advisor or advice. Run as fast as you can. All right. So I will list them here and then we'll go through them briefly one at a time. They are: 1, claiming that he or she can successfully pick the winners or teach you to pick winners. 2, claiming that he or she can successfully and consistently time the market. 3, accepting a commission for the products they sell. 4, recommending a portfolio with an expected return of less than 10%. 5, assuring you that an investment can't lose money. 6, recommending that you move money out of your 401k or stop contributing to it to invest with them. And 7, suggesting that you borrow, even from yourself, from your home equity or your 401k to invest. Doing what is in your client's best interest is hard. It is, because, look, investing is hard. People want to get rich quick. They are bedeviled by fear and greed, which causes them to want to sell when things go down and buy when they're going up. Their brains don't process probability or risk well. They have hundreds of emotional biases they are, for the most part, completely unaware of. And quite frankly, they are, for the most part, really, really gullible. So the path of least resistance is to just give people what they want. And perversely, the industry pays you well for doing exactly that. It's set up that way. Has been since time immemorial. In spite of the fact, right, talking about, number 1, we know and have known for hundreds of years, maybe not hundreds, over 100 years, let's put it that way, that no one can consistently time the market. Meaning knowing when to get out and when to get back in. Okay, that's called market timing. Or pick individual winners. We've known it since the 1900 PhD dissertation of the French mathematician Louis Bachelier, which was largely ignored at the time, but it's now the basis for much of the theory related to the predictability of free market prices. Bachelier's conclusion way back then, right, was that the, quote, the mathematical expectation of the speculator is 0. But, what fun is that? People don't want to believe that. As an advisor, not only does that not maximize my income, but it jeopardizes it. If I am counseling the correct long-term approach to investing, my clients are just sitting ducks to be picked off by some salesman with the next great, more exciting pitch. If I'm a newsletter writer, what do I have to write to about each day or week, if not my latest pick or market call? If I teach a course on proper investing, how do I keep you from getting bored or losing your patience? In financial services, the way to make a lot of money without having to work very hard, frankly, is to give them what they want. And just, as an aside, as a committed proponent of free market capitalism and minimal regulation, at one point, I think I might still, on my Facebook profile, I think for religion, it says free market capitalist. So this is something that I really, really struggle with, because it seems to be a place where the system is broken. And, free markets just aren't working. And the consequences are not just horrific at the individual level, they are about to be horrific at the societal level. You have a looming crisis as the first wave of 76 million people crash up against the wall of retirement without enough money to pay for it. And we all have to figure out, where's that going to come from? Who's going to take care of all these people? You think there's unrest now? Just wait. Anyway, again, that's a tangent. But so let me just say this, so I can keep us moving down the other points. If you'd like a quick overview of, kind of the mathematical proofs of random market prices, there is a quick post I wrote years ago called 4 Schools of Thought, One Conclusion. I will put a link to that in the show notes for those who are interested. The upshot of it is that it doesn't matter how you peel the onion, whether you look at efficient market theory, chaos theory, fractals, right? They all reach the same conclusion, which is that markets are random and can't be predicted. All right, the next red flag is that the advisor is accepting commissions for the products they sell. To minimize conflict of interest, you want to look for what we call fee-only advisors, okay? Because any advisor takes a commission off the products they sell you has inherently a conflict of interest, and you have no way of knowing whether the product he recommends is really in your best interest, or if he's just recommending the product because it pays him well. So there's just no reason, except a big fat commission, that someone should ever sell you actively managed mutual funds, especially proprietary ones to their company, for example. But it happens every day. Variable annuities, which are one of my big pet peeves, or any insurance product that combines investing and insurance is another example. Never, ever, ever mix the two. The rule of thumb, very basic rule of thumb, is buy term and invest the rest. But that doesn't make the life insurance salesman any money. Or in the give them what they want bucket, a conflicted advisor who either overtly encourages you to make frequent changes in your portfolio, and or turns a blind eye and doesn't advise against it. Okay? That's just skimming the surface, but hopefully it gives you the idea. The next one is a little bit more subtle, but I believe that any advisor that recommends or constructs a portfolio for you with an expected annual return of less than 10%, that is a red flag. And you're like, wait, what? Because, by the way, 10% is a lot. But it's going to take at least that for you to retire. At least. And if they don't know that, that's a problem. It means that they either aren't keeping up, that they're still doing things the way we thought about investing in the 1950s, when we had jobs for life, affordable health care, and lifetime pensions. And that is not who you want advising you. Or it means that they do know, but their firm is limited in the investments it can recommend and sell, so they don't tell you that. The formula for required rate of return, which I covered in episode 44, How to Protect Your Portfolio from a Bear Market, is your expected annual withdrawal rate plus the rate of inflation divided by 1 minus your marginal tax rate. if I assume best case numbers, like 5% annual withdrawal rate, which is, by the way, not much, 3.5% rate of inflation over your retirement, which is what we've seen, over this generation. But remember, there have been times when that number is double digits, and a 33% marginal tax rate, your required rate of return in order to pay your bills, pay your taxes, and keep up with inflation is 12.5%. And again, if any of those numbers are too low, you're going to need more. So if your advisor isn't starting with the end in mind and then figuring out how to get you to that finish line, and the hard part, right, helping you stick with that plan once it's implemented, easy for me to say, then they are not an advisor, they are a salesman. And those are two totally different things. Next on my list is assuring you or promising that an investment can't lose money. Or a less subtle version is just omitting any discussion of risk. An employee of mine a few years back showed me a postcard that she received from a financial advisor near her neighborhood. And he advertised a historical annual return of almost 15% with, quote, no known history of loss, end quote. So he didn't come out and say this, but the implication, the obvious implication, is that he can deliver high returns with no risk. Hey, sounds like the perfect investment, right? Well, red flag. There is no such thing as a risk-free return above what's guaranteed by the U.S. government, meaning U.S. Treasury bills, which for the longest time have been down around zero, at the moment have climbed up to about 2%. But that's the risk-free rate of return. So 15% without risk is like saying you can jump up into the air, flap your arms, and fly. It's not possible. But sadly, people fall for it because we want it to be true. And just as another, kind of aside, I don't mean to complain or rant, although I may be a little bit, but just, to kind of give you a window into the other side, right? So if you think about this from the advisor's perspective, it's easier, it's better if we don't talk about risk. For example, I'll give you a personal example, right? When I say, as I used to do, when talking about cryptocurrency, that the trick is to position your portfolio so that you make lots of money if the cheerleaders are right, but if the naysayers are right, you don't lose everything, right? That is an implicit statement about the two sides of the coin, right? And saying, okay, well, we're gonna manage that, which is in fact the job of an investor or an investment advisor, to manage that trade-off between risk and reward. But you can't manage it if you don't know and acknowledge that it's there, right? And it's unethical to not acknowledge that it's there. And yet, right, if I do that, I sell way less. I have less of everything, less webinar signups, less opt-ins, less podcast downloads, less interest than something so simple and so subtle as changing it to what you hear right now, right? Which is that it's also true, by the way, that how to increase your expected return while hedging against risk and protecting against financial crisis, or whatever I say there, right? Which is not even though it's not those, it just isn't. Let's just be honest. It's not those two sides of the coin, right? Now, I do talk about it in the webinar and other things, but just that, and you guys probably don't even notice the difference. You probably don't even know I change it. But the fact that I change it, and the fact that subconsciously affects people's reactions to it. That's what I mean. Like, it's not only is it hard to be a good investor, but we've got all these subconscious, things that say, if you do the right thing, not only will you be penalized for it, overtly financially, but you're also penalized for it because less people are interested. That's just the truth. About how it works. And that's why I say, being a principled financial advisor is really hard because that is not the path of least resistance. All right. So the last two, I'll lump together because they're kind of similar. If someone recommends that you move money out of your 401k or borrow money to invest, again, even borrowing it from yourself, like from your home equity or 401k, you know straight away that person is not legitimate. No one can look you in the eye and tell you that is a good idea, ever. Okay? Borrowing money to invest like that, bad. So, I wish there was no need for podcast episodes like this, but, it's not La La Land, there is. And of course, this list is by no means exhaustive, but hopefully it kind of gives you some mental shortcuts, get you thinking about it. It gives you these shortcuts that you can use when evaluating the information that you hear or read, as well as the advice that is being given and the people giving it. I would say that the number one rule is this. If you have any doubt, right, listen to your gut. If you have any doubt, walk away. Trustworthy and competent sources of advice do exist. Financial advice. They do exist. They're not unicorns, but because they're the exception rather than the rule, sadly, you have to filter for them very, very carefully. So as always, I hope that helps. I'll just mention again the free guide that I put together over at kimsnyder.com. One of these days I'll get a copy of it moved over to Sane Crypto, but for now it's at kimsnyder.com. It's called When Things Get Wild: How to Protect Your Portfolio and Still Get a Livable Return. You can find it at kimsnyder.com, spelled SNIDER, kimsnyder.com/bear market, all one word. Just hit the orange download button now on the right-hand side of the page. You can get the full show notes of this episode, including links and references to all those things I talked about, the articles, the old podcasts that I referenced, the 4 schools of thought on random returns, etc. Those are always, as usual, at sanecrypto.com/podcast. And finally, if you have a question about today's topic or anything else, just email me at askkim@sanecrypto.com. Hopefully you can tell I really enjoy those questions and really like responding to them. I read and answer every email personally, as well as answer some of them here on the show for the benefit of everyone else. Everything I say on the show is for educational purposes only. Nothing should be considered investment advice. Past performance is no guarantee of future results. All investments involve risk. So do not, under any circumstances, borrow or invest money you can't afford to lose. Just kidding. All right, that's it for me. I'm Kim Snyder. I'll be back next week. Until then, may the crypto gods continue to smile on us all.